Okay, so the next category of indicators, we're going to be talking about our momentum indicators. And by definition, simply, momentum indicators show you the strength of a trend, basically the strength of price movement, right? But by application, they are used by most traders to call reversals. In the sense that when a trend has been going on for a while, say an uptrend, right? They use it to call reversals that, okay, at this point, this particular currency pair has been overbought, right? So you want to sell. Or if it's a downtrend, they say this particular currency pair has been oversold, so you want to buy. So let's see how those indicators come on the chart and how they are used, right? Let's see. So now here's the chart, right? Let me load one of them onto the chart. The relative strength index, right? Yeah, this is the relative strength index. Now let me remove this. Just leave the arrow. So this is the relative strength index. Now what you'll find is you can see a purple region right here. You can see this purple region right here. So you can see the wavy lines going up, down, up, down, up, down. And to your right, to your extreme right here, you can see 80, 60, 40, right? Now those, you can see 80 above and 40 below here. Now how this are typically applied is when these wavy lines you see in here, when the wavy lines go above the 80 mark, it is usually said that this particular currency pair has been overbought. Now because it has been overbought, you want to sell, right? If it goes below the 40 mark, right down here, goes below the 40 mark and comes down here, right, you say that it has been oversold, so you want to buy. So it's basically used to call reversals, right? It's used to call reversals. So when the wavy lines go above 80, you say it's overbought, you want to sell. When it goes below 40, you say it's oversold, you want to buy, right? Now let me show you another example of another momentum indicator. Let me show you the stochastic, right? The stochastic oscillator. Let me show you stochastic oscillator. Let me type it in here. Stochastic oscillator. Yeah, got it here. Okay. So it's also very similar, right? It's quite similar. The concept is the same, just that this one has two lines, a blue and an orange line, but the concept is basically the same. When price gets above 80, it's said to be overbought, so you want to sell. When price gets below that 40 region, it's said to be oversold, so you want to buy. Basically, it's usually used to call reversals. I personally don't use these indicators for anything really. I personally don't use, because like I told you, I have my own style of trading. I personally don't use this. Okay, so the next kind of indicators that we use, that we must talk about, are volume indicators, right? Now volume indicators, we talked about volume, right? Volume is very important in Forex because without volume, price is not going to move anywhere. And you need price to move to make profit, right? You need price to move in a certain direction to make profit. Now, the more price moves, the more profit you make, right? When price is not moving, when markets are choppy markets, when price is just making very small movements, those small movements can hit you and cause losses. So that is what we want to avoid. We want to avoid those choppy movements that will cause losses for us. And how can we avoid those movements? Is by identifying a market that is trending. Not only a market that is trending, a market that has volume behind it. That is, if you are saying that, okay, this market is in an uptrend, how much volume is pushing the market up. If you're saying that this market is in a downtrend, how much volume is pushing this market down, basically? So you need that volume to determine how much how much volume is what is driving the market, basically. What is pushing it up, what is pushing it down. So let's see some volume. Let's see an example of a volume indicator. Let me pick one from here. Okay, so if you look closely here, just here, down here, you'll see this red and green, some orange bars, right? So basically, this is typically what you'll see with volume indicators, right? You see bars like this. Now the green bars are telling you that, okay, there is now buying power in the market. Like you have buying power in the market. The red bars are telling you that you have selling power in the market, basically. That's what volume indicators do. That's what they basically do. So the green bars, you have buying power. The red bars, you have selling power. And the higher the bars, the more the volume. The higher the bars, the more the volume. So you can see that some bars are way down here. So it shows low volume. But some bars are way up, like the ones here. It shows that the volume is quite high. So at this point here, right, that the bars are way high and also red, it's giving me a strong indication that, okay, there's a lot of selling power in the market, right? It's giving me a strong indication that there's a lot of selling power in the market. Look right here. See when price was going down, right? See when price was going down. Look how high these bars were, and they were also red, right? So yes, that's what volume indicators do, basically. That's what volume indicators do. So the next category of indicators are volatility indicators. Now, what volatility indicators basically show you is just how much price has moved in recent times. Like how many pips you measure. They basically tell you the range of price movement, how much price has moved in recent times, basically. And I'll show you what that means now. So let's go back on the chart. Right? Let's go back on the chart. Now let me close this one. Now, an example of a volatility indicator, and probably the most useful indicator you will ever find, is the average true range. Let me just load it on the chart here. Average true range, right? Okay, now I have it down here. Now you can see the wavy line. That is not what is even important to us. It's not the wavy line that is important to us. Now, if I move, let me bring back this. Yeah. So if I move this to the last candle we have here, so I move it to the last candle we have here, you see that a number is now being displayed at this point here, where you have ATR. A number is now being displayed, right? That number being displayed, let me bring it back. Number being displayed, you can see 0.00225, right? 0.00225. Now, basically, you read that number the same way you read for the price of your currency. Yes, the same way you read, only that you ignore the 5, right? So it's the same 4 decimal places like you read for price, but you just ignore that 5 because that's a pipette, right? That's a pipette. You can ignore that. So you just read it the same way. So for this now, using our knowledge of pips, right? This 0.0022, right? How many pips do we think that is signifying? That represents? Well, you're right if you said that is 22 pips. Yeah, that is 22 pips, right? So for this particular pair, after this particular candle, right, the average true range is 22 pips. What does that tell you? Now, you can see that it's ATR 14, right? ATR 14, average true range 14, basically means the it just takes the last 14 candles, right? It takes the last 14 candles and looks for the average of movement, like the average price movement of those 14 candles. It just gives you an idea of the range of movement of price. Basically, it tells you, is price moving a lot or is price moving too little? That's what it basically shows you. Is price moving a lot? Is price moving too little? So volatility is very important in telling you, in showing you the characteristic of the kind of currency pair you are trading. Some currency pairs are way more volatile than the other, right? So for this currency pair now, this is Aussie Swiss, right? Aussie Swiss, right? Now we are seeing volatility of 22. Yeah. Now let's check out another currency pair and you'll see what I'm talking about. Let's check out pound kiwi. Pound kiwi. You see what I'm talking about now? Now see, still on that last candle, right? For pound kiwi now, look at what we have. 0.0052, right? So this is 52 pips. So you can tell that this is even is more than 2 times more volatile than the last currency pair we looked at. Yes. So this particular indicator tells you how much movement is happening. Basically, it tells you the range of movement, how much movement is happening. So this currency pair moves a lot. It moves a lot as compared to the last one we checked, the Aussie Swiss, right? This one moves a lot, 52 pips, right? So that's what volatility indicators tell you. Another one is another example is the Bollinger Bands. Bollinger Bands. Let me just load Bollinger Bands on here. Bollinger Bands. Let's see. Yeah, look at Bollinger Bands, right? You can see this. Look at the candles are now within a cloud of indicator, right? So you can see something above here. Let me use the arrow instead. You can see above here. You can see this. Then below, it also has a band below, right? So a band above, a band below, then a middle band, right? So basically, how this tells you volatility is that it's just like band. It's just basically bands, right? Like elastic bands. So the more volatile price is, the wider the region between the bands. So you can see here, you can see there's a lot of width here. It's very wide here as compared to what you have here. It's quite narrow here. So price was not as volatile as it was at this point, right? Yeah. So the wider the bands, the more the volatility. The narrower the bands, the less the volatility. That's basically how volatility indicators work. They tell you how much movement is happening with price as far as that currency pair is concerned, right? So that is what volatility indicators do, basically. Yes. In the next lesson, we'll be looking at some important softwares and applications you need in Forex trading, and chief of them being MetaTrader 4. So,
we're gonna keep it low key, keep it softly spoken.